Good morning, everybody. Welcome back from a long holiday weekend. Hope it was nice for you. This morning, I'm going to be introducing our speaker, but first, let me tell you a little bit about myself. Excuse me. My name is Dave Hughes. I'm the Director of Product Management here at Leverage, which, as you may know, is the service corporation for the League of Southeastern Credit Unions. And today, the title of our presentation, as you can probably see on your screen, is Leveraging Your Core and Your Deposit Strategy. Our presenter is Mr. Jeff Sharkey, and a little bit about Jeff. Jeff is a certified treasury professional, a certified treasury manager, and has over 15 years of treasury management expertise in sales, service, and product management. For 10 years, Jeff worked with a nationally recognized bank with over $100 billion in assets through the transitions of several acquisitions prior to joining the credit union and community financial institution movement. A lifelong learner, Jeff holds 2 associate's degrees in business and business management, certifications in entrepreneurship, business management, marketing management, Bloomberg market concepts, and small business management. Jeff graduated from the University of Michigan School of Management with a BS in business management and further attended his Master of Business Administration at U of M. Jeff is actively involved with several treasury management initiatives that collaborate with community financial institutions to guide and mentor them in the treasury management space. In 2017, he began assisting credit unions with development and launch of their treasury management program, and currently is the vice president treasury consultant for True Treasury, taking a leading role in their enterprise solutions. He's also an executive board member of the Great Lakes Association for Financial Professionals. So if you're wondering about questions, we will take them throughout. We have a smaller audience today, so this is close to being one-on-one, as Jeff mentioned. Not exactly one-on-one, we're not that small, but feel free to jump in, and I will ask the questions as we go, and we may even have some at the end. So with that, without further ado, take it away, Jeff.
Thanks so much, Dave. Appreciate that. I'll have to get a condensed version of that bio for you next time. So it's good to see some of you again. I know that we get to touch base with some of you pretty frequently, and this is great. So basically, what I want to do is just make sure that in general, when we were talking about deposits, the word of the year, that we have the broad topic, and this is where we actually get pretty specific. So hoping that you guys are engaged, want to make sure that we answer any of your questions. Obviously, we have some at the end, but I'll definitely entertain them throughout as well. What we want to do is first of all focus on what are stable sources of deposits. So we'll go through the agenda real quick, and then we'll hit each one of them a little bit more. So I'll blow the punchline of the joke on the stable sources of deposits. If you know me more than a few seconds, you know I'm talking about business deposits, or the deposits you can get with treasury management operating accounts. But of course, we'll talk about more of that, get a little bit deeper. What difference does it make in what core you're on? All cores are not equal. There's pros and cons to each one. And so what we're doing is we're basically looking and saying, okay, what functionalities in the core specifically? So treasury management has a vast array of products, merchant services, remote deposit capture, the positive pays, that those type of products are not necessarily on core. They interact with core, but that's where, we'll get into more specifically the ones that we're hoping to basically flip some switches on, turn things on, and make sure that you're optimizing your core. And this will work for several different ones. Some take more work than others, but that's what we'll get into. Pricing for services. So pricing, we want to encourage pricing to begin with. We have some credit unions that have stood up some products and then, of course, not actually charging for them. And then when I say charging for them, I mean not even passing on minimum costs. So it's actually costing the credit union. We want to make sure that these are revenue streams, not drains to the credit union as a whole. So we'll talk about pricing a little bit more, then building off the foundation. So again, we figure the core is your foundation, building off, and what does that look like? As Dave mentioned earlier, we have a bit of time for Q&A. We'll put that to the team. So you can save up your questions if you want, or put them in chat real time. So I did blow the punchline of the joke to no one's surprise. We're talking about business deposits. I will also make this deck available to anybody who requests it, because what I've found is, in many cases, there's a bit of a struggle for the professionals at credit unions, whether it be in the business services, treasury management area, commercial lending. When, as a credit union, we get some traction on a business initiative, business deposits initiative, or business member focus, we have to prove the worth of it. So this is something that can help if we're building a case to explain the benefits or the positives of having support for the business program. This can help. So that's the other thing I'd like to make sure that we're being cognizant of, and ensuring that, get your questions answered, because this will help as we build out that case. In some cases, even having to go all the way up to the board members. So business deposit, let's talk about why we've seen them be so attractive, comparatively speaking. Anytime there's a deposit or liquidity crunch, what we see, I should say, is typically credit unions will run a CD special. And it doesn't have to be a business CD. It can be any kind of CD. And that's the answer. Like, well, we got to attract some deposits and we got to really pay high interest to get them. Well, if you're having to attract that type of deposit, are they sticky? There's, again, the pros and cons. Like, what are we doing when we offer premium rates? Are we getting the quality deposits? Are we getting the type of relationships that we want to build? Will the person who was attracted to a personal CD rate stick around, or will they just go to the next 0.5% that's higher when they go for renewal? So that's where, again, we want to focus on those business deposits. What we've been seeing, we've got a lot of, we've been around a bit now, got a lot of information on this, is that business deposits typically are larger, significantly larger than retail. So we say 5 figures without TM. So I apologize for the acronym. TM, Treasury Management, could be business services, cash management, cash services. Heard it called a lot of things, but 5 figures, basically what we're looking at is, tens of thousands of dollars without treasury management. When and if we get our core leveraged out, additional products, if we can get treasury management products to be added into the mix and offering for business deposits, and when we're proposing business deposit relationships, we immediately start to see the amounts jump significantly. So if we're talking about a $10,000 average deposit, and again, we're talking about spreading that across business segments as well. Once we have treasury management and business services products, we're immediately talking about $100,000 as minimums that we're seeing, minimum average daily balances. And then obviously we also see in 7 figures as well, that we're talking about millions of dollars of deposits. Those 7 figures, those 6 figures, we're needing those products to be in place. So if anybody was wondering about the chicken or the egg question, do we need deposits to justify our treasury management products and our initiatives there, or do we need the products to attack the deposits? What we've seen is it's really having the products in place first is where you get your deposits. That's why we're talking here today. So stability or stable source of deposits. Business deposits are less fluid. Now, this is a little bit tricky. The economics term is viscosity there, where we want to make sure that it's they move through the pipeline slow. What we want to also consider, because, first thing I thought of is like, oh man, I've seen businesses that spend every dime that comes in, and it's just in and out flow. We're talking about averages, and we're talking about the relationships as a whole. And we're also talking about average daily collected balance. So what I mean by that is how long the money is sitting in the account. And those are what we take as far as the averages. And those are higher, they are more stable. So that's a little bit of a background as far as the data that we're looking at on these figures. So that's that. Requiring lower compensation. So this is tricky too, because it almost seems like a negative thing. And when I say requiring lower compensation, what I mean by that is interest rates. Now, keep in mind, there are more than one way to compensate a business for having their deposit relationships. One could be security. If you're, safe and sound is what I think of. If a business considers your credit union safe and sound, that's more comforting to them in many cases than a high interest rate. So they may be looking for more of that, safe and sound, than interest. So that's where, again, not necessarily getting a little bit off topic here, but if that's where we're able to divide up and rename things or designate things to get more than just the $250,000 minimum of insurance that you get through the NCUA, some institutions have elected to buy excess share insurance. So again, this is the way we're compensating them. We're compensating them with security, safety, and soundness. But what we're talking about here, rates. Typically, businesses don't need the large rates. They don't need the flashy, attractive rates, and sometimes they'll take lower rates for the trade-offs. So that's another reason why we see that. Another one, typically they need peripheral products. So it is a very rare occasion when a business opens up an operating account, because again, we're talking about the more extensive relationships, and all they need is to order checks. The businesses just do more than that. I mean, at a minimum, they're going to want card activity. So basically, probably a debit card. Depending on the size of the business, they may want an entire card program. But we're looking at operating relationships here. So payroll functionality. So whether that be collections as well, where you're pushing and pulling, wiring capabilities, remote deposits, positive pay. So it's very unlikely that we're just going to get deposits in an operating account that just sit there and they write checks. You're going to need these other products. Don't forget, we're talking about these products as revenue streams, not costs. Again, I emphasize that because a lot of credit unions get stuck on, and I say stuck as if it's a bad thing, but their mission is to provide to their membership as many things for as low cost as possible. And then what that means is they're giving it away and incurring the costs or eating the costs themselves. Businesses, we want to make sure that that the cost of these products are passed on to them and they understand that there's costs. So again, trying to stay on topic here. That's another side note that it's very easy to get distracted on. It's more than just checks. So they typically accompany financing. I would say typically accompany financing. When I was in banking, it was always accompanying finance. It was treasury management came after the loan. It's a little bit different because we want to obviously serve communities around us in any way possible in the credit union industry. So it is more common, I would say, to have business deposits or an operating relationship without some type of lending. But that's not, it's not nothing, as some people would say, to be able to get business loans, equipment loans, and that interest income part of the relationship. So again, we're talking about an entire relationship here, and these significantly more profitable. So all of these factors adding up, chew the meat and spit out the bones here. What we're looking at is at least 13x. So for every, call it a retail or personal type of account that you have, it's very easy for us to say you need at least 13 of those personal accounts to equal the benefits of having a business account. So whether that business account has treasury management or cash management, you can see that can definitely increase that 13x as far as profitability. It also varies per relationship. When we're doing programs and projections, sometimes, or as you should see, when we're doing servicing, we can see that one deal can make a program profitable for months because of the type of relationship that it has. We don't want to count on those when we're doing those projections, but they are out there. So again, considerations, things to think about. So that's for the business deposits. Let's talk about core capabilities. This is why we're all here anyway. Your core has capabilities that needs to be optimized. Now, I know that I even looking through the attendees list, I can see there's quite a bit of diversity in the cores that are present. There are cores that are more easier to work with than others. But what happens when we get those easier to work with cores is we find out that pro becomes a con because the credit union has undertook so much customization of that core because it's so easy to customize that it makes it hard to do a simple function because it will throw off so much of the other customizations. So then you have people that recoil from that. And on this core that's easy to customize, they say nothing custom. We're just taking standard. Well, we got to find that balance between them because we don't want too much custom work that creates that annuity of work so that every time there's an update or programmers are busy for 2 weeks. And then also we don't want to not move forward. We don't want to be enhancing our products and services because of the fact that we're afraid of creating all of this work. So what we want to focus on is converting the capabilities of a core into products themselves. So so it might be review for some, but this is also a good time to, again, throw questions in the chat if you have them specifically. We're going to focus first on account analysis. So there's some folks on the line I don't necessarily recognize their names or, maybe I don't see who they are. Reason why I'm saying that is because I don't want to make an assumption that account analysis is a known concept. So do a brief, stay away from those assumptions. Briefly, account analysis is something that I almost call it a banker's gimmick. Because back in the day, it used to be illegal for financial institutions, whether it be banks or credit unions, to pay interest on checking accounts. That's changed. So we don't necessarily have to worry about the illegality of it. But what has happened is bankers, because they couldn't pay interest, decided that based off of an interest type rate, that they wanted to compensate their large depositors and encourage the large deposits. So they would do tiered and call it earnings credits. Well, what are these earnings credits? That's basically an implied interest rate that can be calculated and then applied towards the service fees for some of these products and services. So as an example, they might do payroll. Well, payroll has a cost to run it through. If they're getting $50, $80 worth of earnings credits based off of the tier of deposit balances that they have with your financial institution, they could use that to offset the costs. So it became a way of compensating banks when it was not okay to pay interest. I'm sorry, for banks to compensate depositors when they couldn't pay interest, but still getting that benefit. So that became industry standard in the treasury management world. So what happened was you wouldn't be able to, as a credit union, I've been talking about banks a lot. As a credit union, you couldn't approach a deal because the depositor or prospect would say, what is your earnings credit rate? I was bidding on a large relationship that they said they wanted to pass 2 years worth of history in earnings credits rates that we had offered. Well, when I didn't have the ability to offer earnings credits, I couldn't even answer that question. So it's no, I don't have earnings credit, and no, I can't give you 2 years worth of the rates on that. Well, our whole deal, what we're trying to do is we're trying to get you that yes. So you do offer earnings credits rates, and you are able to answer yes. So earnings credit, account analysis. Another benefit I'll throw in there on the side is you don't have to 1099 for earnings credits. So some businesses actually preferred that. It's one less thing to do as far as taxes. It's not interest, so there's nothing to tax on that. So talked about earnings credits. Well, let's talk about blending relationships as well. And I should say, I skipped the modules part. Just because your core doesn't have certain capabilities, or it doesn't flat out say account analysis, or it doesn't flat out say earnings credits, stick with me. We're going to talk about a way where we can, look into different ways of making this happen. I did put the MBS module, the WILM module. Certain cores have modules that are tacked on, and that can be added very easily and in some cases cost effectively to the current core that you have. So that way you can still be gaining the benefits of account analysis statements, and things of that nature. So that could be another webinar in itself, but that's where we're talking about the modules that can be added on earnings credits themselves. But let's talk about blending relationships, or the ability to even blend relationships. So what happens is it's almost never we will find that a business has one checking account. In order to even have a membership, they already have a savings typically, and then there's also that checking account. Well, they usually have a real estate account, or maybe the account where the building is out of, and they're paying their mortgage out of that. If they want to get efficient and have certain types of transactions posting it, they have a receivables account, and then they might also have a payroll account. We get to these multiple, middle market and sometimes commercial account relationships. They might have 10 accounts where things are depositing in from different locations. Well, what we want to be able to do is we want to compensate them or provide them benefit off of the entire relationship. So this is where we start to talk about blending the relationships regarding the fees and then also the balances that they carry. So if you have 10 accounts and there's $100,000 in each one, when we look at the entire relationship, well, we're talking about a 7-figure relationship. We should be compensating them and respect them as a 7-figure depositor, even though maybe, the largest deposit they have in one of their accounts is $100,000 or $110,000. It's a way of, creating value, additional value, because if you don't have that value, they could just as easily have that those funds at a different financial institution. So blending the relationship is basically where we have the ability to group the account types together and then calculate an interest off of that. And again, you might have to do some research. We can look into it too as well. If you have some questions, contact us offline. There are ways in cores, several different types of cores, where we can make this a reality. So again, some configuration, maybe some programming, but let's try to work towards starting towards a yes and do some research on that. So blending the relationship for compensation, but then also for fee purposes. So I'm using round numbers for examples, but let's say we have 10 accounts. And in those 10 accounts specifically, they each have their own set of services. Maybe they're for different locations and we have to allocate them that way. So they have a remote deposit fee. Maybe they've done a couple wires and each one of those has some ACH activity. Well, if you're the person who's doing the reconciliation and you're looking, you're like, oh my goodness, I have 10 accounts. I have 10 sets of fees, 10 sets of transactions that I have to reconcile. Well, if we're using our core and optimizing it, there's the ability to, I call it blend balances, which we already talked about, and roll fees. So if you have a main operating account, it is quite often that you can point fees from one account to another account. Again, it's a research thing that we might have to do on your core if you're not familiar, if you don't know exactly where to go to turn that on. But when you say billing account or fee account, having a different account than the one that's incurring the fee is a very common practice. So you have that 10 account relationship, and then all of a sudden you have one account of those 10 main operating account getting the fees for the entire relationship. And so we call that the blending balances and rolling fees to make sure that we get the benefit of the blended balances, maximize the tiered rate there. And then the rolled fees is just optimization. One account gets fees for the entire relationship if they want it structured that way. Again, we're getting towards that. Yes, different account structures might want it different ways, but that's where we're headed. So that's what we're talking about when we're saying blending relationships. Pricing. So this could be a world in its own, of course, but when we're talking about pricing, we're talking about the ability to make exception pricing and premium pricing, waivers in some certain circumstances, if it makes sense. We want to be able to pick those apart and offer different rates for different circumstances. I think of it as if you're a carpenter and you have a whole bunch of tools in your tool belt, for different situations. You don't want to hit everything with a hammer. Sometimes you need to cut it. Sometimes you need to measure it. Sometimes you need to level it. It's the same thing. We want to be able to run a pricing scenario in certain circumstances for a large relationship with deposits. And in some circumstances, maybe because of the interest income we're making off of the loan, if we're, again, considering the whole relationship, we do some discounts. So again, being able to do that is very important. The last thing I'll mention here is the analysis statements. So again, this is something where if we in the credit union industry are going to be competitive with the banks, which is our whole goal, our mission, we want to be able to offer those analysis statements as well. If the term's unfamiliar, a brief little analysis statement description is you have your transaction statements where you see every single item clearing with a description on it. Analysis statement is one where we see every type of transaction and how many. So instead of on your regular statement, you see 10 checks clearing, which the amount and the check number for each. On the analysis statement, you'd see 10 checks cleared, not broken down. It's more of transaction activity, volumes, things of that nature. But the ability to even print those. So that's something that in many cases you also have to work with a statement vendor, which we've helped out with as well. There's lots of them out there. You mentioned account analysis. They may want some help in the description or in the reasoning why. So be prepared for that as well. So that's what we're talking about, account analysis. One more thing that I'll go into briefly here is paying that earnings credit. So if you're searching through all of the information on your core and you don't find anything that says earnings credit, but you do find something about implied interest or an interest rate itself, how do you set up your interest rate? We were doing some configuration for a credit union setting up their IOLTA program, a different world. So I'll set that to the side as far as defining what that is. But essentially on that type of program, the account gains interest, but cannot receive that interest. The interest has to go somewhere else. Well, we can actually use that same concept, that same functionality. So as we're in there doing the configuration, we say, okay, calculate the interest. And then there's a flag there on this particular core that said, apply it to the account. So kind of a pay or no pay. Well, if you hit no pay, you've calculated the interest. Now you know what the rate would be, an implied rate. Put it in with tiers if you want to, and then have it not apply to the account. Well, in that case, you can see, okay, this is the amount of earnings credit. Call it the earnings credit. Again, we're getting creative here on different ways to make these types of products work. But that's just an example, one that we ran into recently, and I remembered I really liked that concept. Let's work for it. So that's on the account analysis side. Next, we'll talk about automation. So when we talk about automation, we're talking about treasury products that make the business's lives easier. So moving money automatically. Here we're talking about sweeps, ZBA, and LDL. So I should not forgive the acronyms. ZBA is zero balance account. LDL is loan to deposit link. Again, it's automation. We're moving money without somebody actually having to do anything about it. It's a function that happens at good night or end of night or the end of process, whatever your terminology is. Sweep is have money in your checking. We want to maximize it in interest earned, send it over to the sweep account or to a money market, to savings account that gets more interest at the end of the night. And then if you need to spend money the next day, we can pull it back. So sweeping back and forth. Zero balance account, same concept, but a little bit different, where we hold in that, let's say that 10 account relationship we had mentioned earlier, we have 9 of those items that are into zero balance because it's rolled its balance all the way up to the main account to maximize that interest here. Loan to deposit link is really maximizing not only interest earned, but also minimizing interest expense. So we see that kind of both ways, where we're paying down the loan anytime we can. We're maximizing our interest earned anytime we can. And this, we're talking about automation. Well, how? How do we do that? The way to automate that is essentially think of it, and this is, again, concepts wise that we're talking about. If it doesn't have the function that you can just simply turn on, we can talk about overdraft protection. That's something that almost every court has the ability to do. Well, essentially, if we have overdraft protection, we're sweeping money from another account. So there's a way to have that link. We want to maximize it. In a business world application, we say, all right, overdraft protection, only we want it to push and pull both ways. Have the other account be that investment account or money market, whatever it is that you want. Turn off the fee, because obviously there's a per item fee on overdraft. But if you turn that fee off, and then also make sure it doesn't show up on any negative reports, that's another big one where we had to make sure that they're not penalized for using this sweep functionality that we've intended this way. Essentially, we've just found and created the sweep functionality within the core by renaming products in a way. Speaking of renaming products, talk about fraud protection, and I'll have to kind of kick up the tempo here a little bit. So forgive my speed here. Fraud protection blocks and filters on the core. So what we've seen is many types of cores have the ability to put transaction blocks, whether it be an ACH transaction, completely blocking all types of ACH, or same with checks, completely blocking all types of checks. The filters is another functionality where some cores will allow on ACH items coming through us to label 9 or 10 of those items and say these are acceptable, and filter out the rest. Nothing else gets through except for these. And these are all on core. These are not something that you have to get a positive pay module and add on and have some type of API integration or SSO integration. These are all things that are already there, and we're simply utilizing and turning on. The way to do that, and again, we're thinking outside the box. Think of it as a stop payment with a monthly fee and never expiring. So the check block, as an example, we put 0 to all 9s for check number and 0 to all 9s for number. So configured on your core just like a stop payment, but anything that comes through is blocked and just returned. It's a safety and soundness functionality that many businesses will pay for on a monthly basis. So the same thing on the ACH side, using that stop payment functionality, that transaction at the transaction level blocking, creating that block and filter. And all of a sudden, once you've done that, you've now created another treasury product that you can legitimately market on your website. I always love to think on the website, like, do you have blocks, ACH blocks and filters on your core? We can say yes to these items. Do we have automation? We have yes. We can say that. Count analysis, yes. So that's our goal. Let's get to those yeses and get to your website being proud of a product set that we can be proud of. So pricing services, again, kicking this into high gear. Packaged accounts. So it's very common that we see in a packaged account situation, an item count that can be included for no charge. So if we're having multiple types of accounts, let's say a business, a no monthly fee business checking, maybe it comes with 150 or 200 items. When we're packaging items included, we're thinking about checks, debit card activity, deposits. They get 150 of those included. And then above that, because there's costs, again, don't forget that we have to pass on. Above that might be 40 cents, might be 50 cents an item. Again, encouraging behaviors, but we can get into more of that later on. But those capabilities are on just about any core that we've seen. So there's that. Waivers, service charge waivers for PEG balances. Again, with some configuration and possibly some optimization that we'd have to help out with. Point being is you can pick a PEG balance, let's say $40,000 and say, if the business holds this, it's an if-then statement, if this, then they don't get that monthly service charge. So again, some functionality that's typically already on your core. Now, those are things that I've seen in retail accounts, on personal accounts, encouraging specific balances. Well, we're using that same functionality that's already on your core, and we're relabeling it and naming it business products. Tiers. So tiered earnings credit rates for incentivization, the same as we were talking about just paying regular interest rates. The higher the rate, or the higher the balance, the higher the rate. We can use that with that implied interest rate that we were talking about and make sure that we're encouraging people to bring balances in. So analysis plans. Now that's some cores call it different things. So what we're basically talking about is the ability to have a specific set of pricing or parameters applied to a specific type of account. And you might be able to have that in more than one circumstances for that specific account. So we have an account type, and then we have kind of a plan for that, a pricing plan for that. So some cores that I've seen have up to 99 to 100 different pricing plans that can be applied to your types of accounts. Again, we're getting a little complex here, but think about it in the ability to say yes scenario. What happens is you can set in the pricing that you're charging for the services and then have it applied to an account, and then have a different set of services pricing applied to that same account type, but we're offering it to different, it could be even different business segments. So maybe it's different for medical arts than it would be for education. So those are things where I say here, don't be afraid to use them, because what had happened was when we were doing a configuration, we had come up with about 12 different plans that we wanted to offer. And when we came to the team who was implementing them, they sort of scoffed and said, we only have 8 for the entire credit union, and you want 12 of your own. Yes, we did. Again, we want to make sure that we're optimizing, we're really utilizing all of the functionality that's in the core. So don't be afraid to use them. Don't be afraid to say, oh, it's analysis plan 50. It's analysis, and that's getting extreme. But when we're in the 30s and the 20s, you can have your little label, document everything well, have a spreadsheet that shows which plan offers which things, utilize it, maximize it. So the next thing here is the carrot and the stick. Guide users to correct account types and usage. So the stick, we'll talk about it, is those overage fees that we were talking about. So you get 150 or 200 items included. If they had 70 extra items, probably a low volume account is not the best fit for them. Maybe they need to be in the mid-grade account that has higher items included. It does have that monthly maintenance fee, but they're going to be better off because they were so far in the overage on the free, the items included account. So we're encouraging the behavior. That's where, we talk about the stick, but the carrot, right? The carrots we talked about is those peg balances. If you're able to keep some cash on hand, keep some deposits in here, then we can offset some of those, or maybe waive a monthly maintenance fee. So again, think about it as guiding business depositors and business relationships into the best type of account that is out there for them, the most options. And then the last thing here, diversify your product set. So I spoke about this before with the concept of analysis plans, but nonprofits, municipality, retails, builders, trades, what I like to think of is if you have a specific seg that's in your area, in your credit union footprint, a common one is education, a common one is medical, then you can create through either an additional account type. So you have your regular business accounts, layer on top of that with just minimal changes, the medical or the dental practice business accounts. And then again, think about it, marketing on your website. We have a specific product set for medical arts. We have a specific product set for therapists, for dentists, for lawyers. I put in here for retailers, builders, the craftsman account type. Those are type of things that are very easy to rename business accounts, or, use the same programming, maybe give them additional items included. You don't have to make them, extremely different, but diversifying and saying we have specific product set for nonprofit. That can get you a win right there. Here's our nonprofit account type. Here's our municipality account type, depending on what state you're in. So that's what I mean when I say diversifying the product set, definitely maximizing the advantages there. We're talking about building off the foundation here. So again, this is what I'd almost consider picking the low-hanging fruit. So reporting, and then once we have all of these things in place, proposals we can be proud of. So on the reporting side, are you leveraging core reporting? What core reporting do you have access to, if any? Is this something where you have to ask to have a special program done, well, that small amount of investment in that program can be very, very helpful. So knowledge of where you're currently at, running reports on the business accounts that you currently have. So what is a balance report? Business accounts, balance report. Great place to start. Mining for additional activities, deposits, big business segments. So if we can start sorting those reports, maybe we get a CSV or an Excel of all business accounts, starting to mine through those and see, okay, what type of have the same name? There's a name in their industry. So something, if it's a dentist or dentistry or something like that, again, I'm picking low hanging fruit here, but we can start to really understand who is in our current portfolio, and then also maybe who we need to go after more a little bit. So then we're talking about those proposals you can be proud of and the structures, those competent account structures, as we like to say. So automation, compensation, when we can get to those yeses. Do you offer sweep accounts? Yes. Do you offer zero balance accounting, any kind of a line automation? When we get to say yes to those, we get to a lot more opportunities, because some of the treasurers and controllers that we're dealing with, they're not going to go without that automation because they figure it saves them a full-time person in some cases. So again, something we can be proud of. The multiple scenarios. So options 1 through 4. I love to be able to come to a deal or a proposal or a prospect, I should say, and say, here's what it would look like in scenario 1, where you have this type of account and then 3 feeding into it. Maybe then you come with proposal option number 2 that says, sounds like you wanted them all separate. Here's A, B, C, and D. And this is what it looks like when everybody is, very segmented, and we have the controls in place, the checks and balances, those barriers that are intentional. Coming with multiple scenarios is great. And that just leads to this third thing out here. This is ways to say yes. And I talked about more tools in your tool belt, when you can come at them with different proposals and different scenarios based off of the product sets you built out. It increases significantly the likelihood that you'll be able to win the deal or to get an additional audience. So we're winding it down because I wanted to be cognizant of everyone's time here, bringing it all together. We talked about the business deposit focus because, that was why we're here in the first place. Treasury management, business services professionals, optimizing the core capability for products. So again, if you have it on core, we might need to look into what the functionality is. Don't look in your core documents for zero balance account, because it might not be in there. Maybe don't even look for automation. Think of different words to describe it. A bit of education is needed, because even when I was doing configuration in a credit union that I was working at, sometimes I'd have to stop, take a step back, and then explain the functionality and why it was even needed. So think about those type of things. Optimizing the pricing capabilities. Again, pricing is where it can start to get more complex, because if some person paying one fee and not another, making sure you have your policies and procedures in place to make sure that that's acceptable and not going to get you in trouble for an audit. But having the ability to do that can win deals for sure. Utilizing core capability for proposals. So again, more tools in the tool belt where we're coming at them with different scenarios helps to bring the whole efficiency, the whole program together with the reasons why there. And if we're doing all of that effectively, we can claim, obviously, that our core has been leveraged to the maximum, and it helps out with that deposit strategy. So, with that in mind, that's what I had for the team for this timing, I should say. And if there are any questions, I didn't see any in the chat, and that's fine. Just wanted to turn it over to the team. Dave, if you had any questions that you wanted to submit or that you had, let me know. This is the time we earmark for that.
Thanks, Jeff. I do have a few questions here. What is the normal asset size for a credit union that you work with?
Okay, so that's a loaded question, fun one, a little complicated. The reason I say that is because we do so many different things, but let's talk about the core capabilities specifically, which in a way includes their advisory roles. So at True Treasury, we do consulting, advisory, but then also products itself. So putting all of that off to the side for a second, what we've done is an example. We have a sweet spot where it seems like credit unions just under $1 billion love to use us for, and maximize their capabilities there. But big but there is we have 3 of the top largest credit unions in the world that use our services on that fashion, that want to make sure that their cores are optimized and that they're doing the right thing by their business members. So there's that large, there's kind of the average. And then last September, we signed with a $90 million credit union. So it's one of those things where the answer is yes, we can help just about any different type and size that you'd like.
Okay, another question is, what cores do you normally work with?
Yeah, that's a that's a great question. One of the most common ones that we see is scimitar, and that's because in many ways it's a geographic thing. It's also part of our ownership group, but we also do Fiserv. CU Answers is another one that's popular. We've seen Finastra even come up a couple times. Correlation has been growing, a lot of correlation recently. So I've seen Visify, like I said, Fiserv, DNA. Fiserv have a lot of different kinds, so those are, three initials after it. So those are some of the most common ones. We have one that built their own core, and so that's all kinds of fun. So that's what I would say there.
All right. And last question I have here is, what kind of product adoption do you get?
Product option. So that's another good question. I think of that as far as end user. So we build the products on our core. What type of people are using the ZVA? So we put all this time and energy into setting up ZVA. What type of use? And what I would say is it is something that we need to plan on a ramp up. What I mean is going back to that chicken or the egg thing. So when are we going to have people walking into our branch and member center offices saying, can I have a zero balance account? The answer is going to be no. But if that happens, when that happens, and when you're doing proposals, if you don't have the ability to do that in the first place, you won't get those opportunities. So we recommend the time and investment to put the product set in place, and then you can team with people who are familiar with the product set. A lot of commercial lending, there are a lot of credit unions that have commercial lending that we can also team with as well to get audiences to explain the benefits of some of these products. So I would say that varies a bit, but it's one of those things where you have to be able to say yes in order to get the adoption in the first place. And that's what optimizing your core is all about. So.
All right. Well, that's all the questions for today, Jeff. I'd like to thank everybody for joining us today. Thank you for taking part of your day to spend with us. And Jeff, thank you so much for your valuable time. Very informative presentation. And I put in the chat that if you'd like a copy of the slide deck, you can email me. In fact, my email address probably came with the invite or the confirmation for this webinar when you registered. I'll also provide a link to the recording, and then in the future, coming up for the next Learning with Leverage webinar, that will be on June 25th. We're going to take a break. Normally we do these on the second and fourth Tuesday of the month, but the next date is SCUSY. So we hope to see you all there. And the next Learning with Leverage will be titled Preventing Fraud in Digital Channels. And that will be with another Leverage preferred partner, this time Eltropy. And once again, thank you for your time and have a great rest of your day.
Thanks, everyone. My pleasure. Bye now.